All right, let's take a look. We got a really interesting piece today on our market measure. Let's take a look and see what we got.
Okie dokie.
So the research team put together a piece yesterday, which was a follow-up to Jacob did a piece on all these different kinds of like ways to measure CVaR on Wednesday. It was kind of heavy. Lots of different ways to manage. I shouldn't say to manage CVaR. Lots of different ways to manage outlier risk, right? Remember the piece? A couple different ways to do it. You know, all of it's really complicated math. We do it on the platform for you, real simple, you know, CVaR. But
additional value at risk, right?
yeah, but what it does is it really measures kind of like, you know, when you're putting on a trade, you're wondering, well, if I'm going to do a trade, and let's say on the Tasty platform, it shows you what you're like. It does it. It looks at thousands of potential trades, just like that. It does this Monte Carlo simulation, looks at thousands of potential trades, and it essentially says, in the worst 5% of all cases, this is how you'll end up with this trade. Like let's say you're selling, you know, a call in the spiders. It'll say in the worst 5% of all cases, you'll lose $1,000, right?
Okay.
Because it's a way of looking at your outlier risk. Because nobody else really, there's no way to put context around outlier risk. Like you can put context around everything but outlier risk. So if you want to look at outlier risk, you know, which is the way firms like us, like Tasty, look at their customer business. It's the way the regulators look at the business, the clearing firms, everybody else. You know, where's the outlier risk? If you want to look at outlier risk, you determine what happens in the worst certain number of cases. So they look at CVaR. So in the case of CVaR, let's say your risk is selling a call, whatever, is $1,000. Could be a put, it could be anything else, but let's just say it's a call. Let's say it's $1,000. So one thing we looked at is all the different ways to look at that to see if that number, if that CVaR number is really accurate. And the answer is it's pretty damn accurate. There are other ways to look at it that may be just as accurate, that may be, you know, a couple of pennies more, whatever. But the point is that CVaR number is really accurate. But that CVaR number is at expiration, right? That's $1,000 at expiration. So how do you reduce your CVaR? So what we're going to do today is we're going to give you a back of the envelope way to reduce CVaR. What we're essentially going to,
I like it.
What we're going to say, and we're going to keep it really simple. Let's say your CVaR is $1,000. That's what happens in the worst 5% of all cases if you held to expiration. So now what we're going to do is we're going to say, okay, if you manage at 21 DTE, your CVaR is only 500. Whatever else you do, like manage at 50% or, you know, do something else or whatever else you do, nothing's going to reduce your CVaR like at half the time. So if you're doing a 1-day trade, you manage in the middle of the day. If you're doing a 7-day trade, you manage it 3 or 3.5 days or 4 days. If you do a 20-day trade, you manage it 10 days. If you do a 60-day trade, you manage it 30 days. You do a 45-day trade, you manage it 21 days. But if you consistently manage it 21 days, you reduce your CVaR by half. That's a simple back of the envelope way of looking at risk. Now, what we're going to do right now is give you the math behind that to prove it.
Okie dokie.
Because at Tasty, cool. We say a lot of stuff, but then we back it up. So trading involves risk. All trading involves risk. Awareness of this risk is a vital step when evaluating a potential trade. So conditional value at risk for a trade measures the downside tail risk by averaging the losses from the worst 5% of all outcomes. Conditional value at risk, CVaR, for any trade manages the downside tail risk. These are obviously undefined risk trades. Measures the downside tail risk by averaging the losses from the worst 5% of outcomes. The platform provides a theoretical CVaR values by using Monte Carlo methods to simulate holding positions through expiration. At Tasty, we have long found the benefits from managing trades early. If we intend to manage, how should we interpret these expiration CVaR values? So on the platform, it shows you CVaR. However, if you want to know, if you're going to manage early, you want to know what your real risk is, you're going to take about half that. And we're going to show you how that works. Next slide, please, Beth. We use 15 years worth of data in SPY, IWM, Qs, Apple, Google, and TLT.
This is going to be cool.
We considered selling 45-day strangles, with a variety of initial deltas. We calculated the CVaR from following these possible mechanics as a percent of CVaR from holding through expiration. So we either close the positions at 21 DTE, we close the positions if they reach 50% of max profit. Those are both our mechanics. And we close the positions if they lost twice the initial credit.
Yeah, they had to come up with something to measure, when do you stay into it and when do you get out of it? Otherwise, you could stay into it into perpetuity and it would possibly work out. You know what I mean?
So we answer these same questions every single day. Which is better? 21 DT, 50% max profit, 2 times the initial credit, blah, blah, blah. Those are the questions we get all day long, every single day, from thousands of people all over the world. We're going to make this really simple for you. Next slide. We're going to take you through a bunch of these stocks. I'm not going to go through every single line item, okay, because you guys can do it yourself afterwards. You can look at it all that kind of stuff. But as you see here, this is just an example. So on the left-hand column is the deltas, 40, 30, 20, and 16. Next column is CVaR, which is, what happens in the worst 5% of the cases. This is
at expiration.
At expiration. Then we looked at 21 days, 50% max profit, and 200% stop loss, 2 times the initial credit. So you sell something at $1, you buy it back at $3. Okay, here's what's really interesting. It's that 21 DT column. Basically, it's you reduce your CVaR by over 50% if you manage at 21 DTE. If you manage at 50% of max profit, you don't really change your outlier risk at all. If you manage
remember,
at 200%,
we're not looking at profit and loss here. We're looking at the risk of the trade, and I think that's important to.
We're only looking at the worst 5% of all cases. So what happens when you sell a 1 lot in the SPY, let's say the 20 Delta, you sell a 1 lot in the SPY, whatever you sell it for, and over 15 years, and your outlier risk is about $1,700. If you manage a 21 DT, your outlier risk is about $700. But if you manage at 50% of max profit or 200% stop loss, you don't really save a dramatic amount. A little bit more on the 200% stop loss, but still not dramatic.
Sure.
But at the 21 DT, it's dramatic. So your
CVaR
really
validates a lot of things here. Not only the 21 day, but really what is a stop loss value here?
Exactly. And the 50% max profit, this is where the problem is. So go to the next slide.
We're not even talking about rolling up the untested side or anything like that. That would be too subjective.
No, there's no rolling.
Right, I know. I just want to point out.
So if you look at IWM, it's essentially the same thing. Stop loss is not horrible in here on the 20 deltas, but
yeah, sure, I get
the 50% of max profit just doesn't make as much sense as a 21 DT. Go to the next one. These are all ETFs. So IWM, same exact thing. Okay? There's no difference in any of these slides, which is why I'm not going to spend time on them. I'm just showing you that we did all the research.
There's no difference between the different products. The numbers work out.
We did the research so you don't have to. And
the 21 day looks optimal.
Yeah, in the Qs, the same thing. And the stop loss risk in the Qs is much higher. But if you're trying to reduce your outlier risk, you just manage at 21 DT. That's it. Doesn't matter what strike you sell. Doesn't matter what you do. You manage at 21 DT. Let's go to the next slide. Now, if you're talking about stocks, so is Apple the same thing? And the answer is yeah. Individual stocks, 50% of max profit didn't really do it, but 21 DT did. Let's go to the next slide. And what you can see in Google is it's almost the exact same thing as everything else. And the most consistent column every single time is the 21 DT. It just reduces your outlier risk by half. That's all there is to it. It's like game over.
Side note, if I had known something like this,
yeah, but
40 years ago, I'd be wearing that stupid silly hat. And you'd be outside the glass again, like you were at the nightclub, waiting to get in.
Yeah, that never happened, just for the record. Ever. Let's go next slide. Waiting to get in. TLT, same exact thing. Every single, whether it's an index, whether it's an ETF, whether it's a stock, everything was the same. Next slide. Okay, so some of the takeaways. And again, this gets a little, this gets a little crazy because all the concepts here, like Tony said, I wish we had known that we could reduce.
Sure.
If we knew we could reduce outlier risk, I think we would have always traded differently forever. Because the one thing that used to scare us as professionals was outlier risk.
Absolutely, and scare the clearing firms and scare everyone, especially when there was really no limit on how much risk you could have at one point.
It's the only thing that can put you out of business.
Yep.
CVaR on the platform assumes positions are held through expiration, which can overstate the risk an active trader is actually exposed to. Neither managing 50% winners or 2x stop loss order were reliable means of reducing conditional value at risk. Managing a 21 DT, regardless of the performance, however, reduced tail risk from selling 45-day strangles by about half. Somewhat more in ETFs and slightly less in equities, but the reality is it reduced everything by about half. So if you're trying to reduce your outlier risk by half, it's pretty simple. Manage a 21 DT.
Better yet, Sadnaf, I would have wished the clearing firms would have known about this 21-day idea, and they would have said, listen, you can have as many positions you like. Just do me a favor. Roll it 21 days. You don't have to buy any of these wings. It would have been beautiful.
There you go.
We'll be back in 90 seconds. We've got more Tasty Live after this with your phone calls, 855-238-2789 or 855-BE-TASTY. We're going to have a half an hour or more to go to your questions. You must have them. If you want to know what to do when the market is at 48.15, you call Saz. He'll tell you. We'll be back in 90 seconds with Tasty Live.